Have you noticed how quiet the mortgage market is right now? I mean, it's almost unnervingly still. Well, that calm is pretty deceptive. Today, we're going to pull back the curtain and show you why this quiet is really just the sign of a storm that's brewing. Let's dig in, starting with the one number that tells the whole story. So here it is. This is the number at the very center of everything we're talking about today, 6.33%. That's the national average for a 30-year fixed mortgage, and for days now, it's barely budged. You know, in a market that's usually bouncing all over the place, that kind of stability, well, it's a huge red flag. It feels like that deep, quiet breath right before the plunge. And that leads us to the big question, right? The one that really matters for anyone even thinking about buying a home or refinancing. Yeah, the market looks calm on the surface, but should you be? The short answer? Probably not. And we're about to show you exactly why. Okay, first things first, let's ground ourselves in the facts. Before we can figure out where rates are going, we have to know exactly where they are right now. So we're going to take a quick snapshot of today's market, using the most up-to-date numbers we can get our hands on. And just so you know where we're getting this, all the numbers we're about to look at are pulled straight from Bankrate's analysis for October 8th, 2025. So this isn't guesswork or speculation, this is the real-time data that lenders and borrowers are looking at this very second. Just look at this table. See how flat everything is? The 30-year fixed is just holding steady at 6.33%. The 15-year is just a tick under that. Now, pay attention to that column next to it, the APR. That stands for annual percentage rate. That's the number that includes all the fees and other costs, so it tells you the true cost of the loan. And even there, the changes have been tiny. The market is well and truly stuck. So, if the market is stalled, the big question is, why? To get that answer, we need to look under the hood. We've got to see the powerful economic forces that are locked in this massive tug-of-war just below the surface. This quote really just hits the nail on the head. While that rate on your screen looks totally peaceful, underneath it all, these giant tectonic plates of the economy are grinding against each other. And trust me, one of them is about to give way. When it does, that 6.33% is going to feel like a distant memory. So what are these hidden forces? Well, it's the big three. And right now, they're all pulling in different directions. First, you've got inflation data that's hinting things are cooling off, which would normally push rates down. But then, second, the 10-year Treasury yield is getting nervous, and that reflects a lot of uncertainty. And why is it uncertain? Because everyone is waiting for the third force, the Federal Reserve's next big move. That tension right there is what's causing this whole deadlock. Let's just zoom in on that Treasury yield for a second, because it is so important. Seriously, think of it as the market's crystal ball. It's like the pulse of investor confidence. When investors get nervous, they pile into these super safe government bonds, which pushes the yield down, and mortgage rates tend to follow. But when they're feeling confident and selling bonds, the yield goes up and it pulls mortgage rates right up with it. Right now, nobody knows which way it's going to go, and that is a key reason the whole market is holding its breath. Okay, so this is where all this high-level economic stuff gets really personal. With all these forces ready to make a move, you have a huge decision to make. Do you jump in and act now, or do you wait and see which way this storm is going to break? And let's be clear, this is not just some academic exercise. We're talking about real money here. A tiny shift, just a quarter of a percentage point on, say, a $400,000 loan, that can easily add or subtract over $20,000 in interest over the life of the loan. The stakes for your financial future are incredibly high. So here's the core dilemma, the big gamble. If you lock in a rate now, you get certainty. You're safe if rates spike tomorrow. But you risk that awful feeling of seeing rates fall a month from now. On the other hand, if you wait, you're betting that rates are going to drop, but you are completely exposed to a sudden surge that could totally wreck your plans. There is no easy answer here. But hey, just because there isn't an easy answer doesn't mean you don't have a plan. Not at all. In this last section, we're going to break down 3 distinct, really powerful strategies you can use to navigate this uncertainty and make the absolute smartest move for you. All right, strategy 1 is the lock and shop. You find a lender who offers what's called a float-down option. This is great. It lets you lock in today's rate so you're protected from a spike. But if rates fall before you close, your lender will actually let you take that lower rate. It's kind of the best of both worlds. Second, the data-driven watch. This means you don't just wait around. You actively watch that 10-year Treasury yield. You pick a target rate, and you get your application ready to go so you can pounce the moment the market hits your number.
And finally, there's the hybrid approach. This is where you might consider an adjustable rate mortgage, an ARM, to get a lower initial rate for a few years, betting that you'll be able to refinance into a lower fixed rate before it adjusts.
At the end of the day, this is the real takeaway. You can't control inflation, you can't control the Federal Reserve, but what you can control is your own preparation. By understanding these options, a float down, a data trigger, a different type of loan, you put yourself back in the driver's seat. You're no longer just a victim of the market, you're an active participant with a solid plan.
So we're going to end right where we started. That little period of calm we're seeing today, it's ending. The economic forces are building up, and a big rate shift isn't a question of if anymore, it's a question of when. So the only question left is, will you be ready when it happens?